Welcome. Today we're going to look into the first quarter 2025 results from UPS. Quite a bit to unpack, including some big strategic moves they've announced.
That's right. They just released these numbers, and there's definitely a lot happening.
Okay, let's jump right in. And hey, if you find this breakdown helpful, we'd appreciate it if you'd like this and subscribe for more updates.
So first off, that headline number. Consolidated revenue for Q1 2025 was $21.5 billion.
Right. And how does that stack up against last year?
It's actually down slightly, about 0.7% compared to the first quarter of 2024, which was $21.7 billion.
Okay, a small dip in revenue. But what about profit? Sometimes that tells a different story.
It does here. Consolidated operating profit on a GAAP basis actually increased by 3.3% to $1.7 billion.
Increased. Okay.
Yeah, and the non-GAAP adjusted figure, which they often highlight, was $1.8 billion. That's up 6.9%. So slight revenue decrease, but profit holding up, even slightly increasing.
Interesting. And the earnings per share, that's always a key figure analysts watch.
Definitely. The GAAP diluted EPS came in at $1.40. The non-GAAP adjusted diluted EPS was $1.49.
$1.49. And how did that compare to expectations?
That was actually pretty good news for them. It's a 4.2% increase compared to last year, and importantly, it beat the analyst consensus, which was around $1.41.
Ah, okay. So a beat on the adjusted EPS despite the slight revenue fall. Now, you mentioned GAAP and non-GAAP adjusted figures. There's usually a reason for the difference.
Yes, exactly. UPS points out that the GAAP results include a net charge. For this quarter, it was $83 million, which works out to about 0.09 cents per share.
And what makes up that charge?
Well, according to their release, it's primarily two things. First, about $44 million in after-tax costs related to their transformation strategy. We'll talk more about that later.
Right, the restructuring.
And second, a $49 million non-cash impairment charge after tax. This was related to certain assets and investments they hold.
Okay, so transformation costs and asset write-downs. Were there any offsets?
There was a partial offset, yes, a $10 million benefit because they partially reversed an income tax valuation allowance.
Got it. So that explains the gap between the $1.40 JAP and $1.49 adjusted EPS. Okay, let's maybe break down the performance by their main business segments. How did U.S. Domestic do?
U.S. Domestic actually saw revenue increase. It was up 1.4% to $14.46 billion.
Oh, interesting. So the overall dip wasn't from the domestic side. What drove that growth?
It seems to be a mix. They mentioned higher revenue from air cargo specifically, and quite significantly, revenue per piece was up 4.5%.
Revenue per piece up 4.5%. That usually means better pricing or shift in mix.
Likely both. This jump in revenue per piece was strong enough to offset the fact that overall volume actually declined in the segment.
Okay, so lower volume but higher revenue per package plus the air cargo boost led to overall revenue growth. What about profitability in U.S. Domestic?
Profitability looked pretty strong there too. The GAAP operating margin was 6.8% and the adjusted margin was 7.0%.
And in dollar terms?
GAAP operating profit was $979 million, which is a solid 17.5% increase. The non-GAAP adjusted operating profit was even better, hitting $1.011 billion. That's up 19.4% compared to Q1 last year.
Wow, nearly 20% jump in adjusted profit for domestic. That's quite something given the macro environment. Okay, let's switch gears to the international segment. How did that perform?
International also saw revenue growth. It increased by 2.7%, reaching $4.373 billion.
What was the driver there? Was it pricing like domestic?
Not primarily. For international, the main story was volume. Average daily volume grew by a pretty healthy 7.1%.
7.1% volume growth internationally. That sounds positive. Did that translate into higher profit as well?
Well, that's where it gets a bit more mixed. The operating margins were still quite high, 14.7% on a GAAP basis, 15.0% adjusted.
Okay, strong margins. But the profit changed.
Profit actually dipped slightly year over year. GAAP operating profit came in at $641 million, which is down 2.3%. And the non-GAAP adjusted figure was $654 million, down 4.1%.
So revenue and volume up, but profit down a bit. Any color on why? Higher operating costs, maybe.
They didn't elaborate extensively in the highlights, but yeah, often when volume grows that fast, you can see cost pressures, maybe network costs or integration expenses that slightly dampen the profit conversion, even with good margins.
Right, makes sense. Okay, that leaves the third segment, supply chain solutions. How did that fare?
That segment saw a fairly significant revenue decline. Revenue dropped 14.8% to $2.713 billion.
14.8% decrease. That's substantial. Is there a specific reason for that?
Yes, there is. They explicitly attribute a large part of this decrease to the divestiture of Coyote Logistics, their truckload brokerage business.
Ah, right. They sold that off. So that sale is really impacting the year-over-year comparison here.
Exactly. It makes a direct comparison a bit tricky. Profitability in this segment was also down considerably.
Let's hear the numbers.
The GAAP operating margin was quite low, just 1.7%. The non-GAAP adjusted margin was better at 3.6%.
And the operating profit itself?
GAAP operating profit was $46 million. That's a steep drop, down 62.9%. The non-GAAP adjusted profit was $98 million, which is also down significantly, by 55.0% compared to Q1 2024.
Okay, so supply chain solutions clearly facing headwinds, largely due to that Coyote divestiture impacting the top line and flowing down.
Precisely. It really reshapes the look of that segment compared to a year ago.
So putting it all together, domestic strong on profit despite volume, international growing but with slightly lower profit, and supply chain solutions down mainly due to the divestiture. Now, you mentioned transformation costs earlier. It sounds like UPS is making some big changes.
They are. Alongside these earnings, they've been quite clear about major strategic restructuring initiatives. They frame it as a response to the uncertain macro environment and also anticipating lower volumes, particularly, they note, from Amazon.
Lower volumes from Amazon. That's a key customer relationship. So what are these initiatives? What are they actually doing?
Well, the most attention-grabbing one is probably the workforce reduction. They're planning to reduce their workforce by approximately 20,000 positions during 2025.
20,000? Wow, that's a significant number. Is this entirely new?
It builds on previous efforts. You might recall they already reduced headcount by about 12,000 last year under their Fit to Serve initiative.
Right, that was more focused on management layers, wasn't it?
Exactly. Streamlining management structures.
Yeah.
They expect that specific initiative to wrap up this year, 2025. This new 20,000 reduction seems broader.
Okay. What else besides headcount?
Facilities are also part of it. They plan to close 73 buildings. These are both leased and owned properties by the end of June 2025.
73 buildings just in the next couple of months.
Yes. And they added that there could be more closures after that as they continue reviewing their network.
So workforce reduction and facility closures. Is there an overarching program name or strategy for this?
There is. They're calling it the Network Reconfiguration and Efficiency Reimagined Initiative.
Catchy name.
Yes. They say it builds on their previous Network of the Future program. The focus seems to be squarely on boosting efficiency, especially within the U.S. domestic network.
How are they planning to do that?
Key elements seem to be increased automation, that's a recurring theme, and consolidating their operational sort activities. So basically trying to handle volume in fewer, more automated, more efficient hubs.
Which implies, I suppose, further facility consolidation beyond the initial 73 and probably workforce shifts as well.
That seems logical, yes. They mentioned facility and workforce consolidation plus process redesign across the network as part of this reimagined initiative.
These kinds of transformations, they don't come cheap usually. You mentioned some costs hitting the Q1 results. What are the expected costs going forward?
Right. They recorded $58 million in those transformation strategy costs just in Q1. For the full year 2025, they're estimating between $400 million and $600 million in total expenses related to these restructuring programs.
$400 to $600 million this year alone. What kind of costs are included in that figure?
It's a range of things you'd expect. Costs tied to retiring assets, lease obligations for those closing facilities, consulting fees, and importantly, employee separation benefits, severance packages, basically linked directly to this new network reconfiguration initiative.
Okay, significant costs, but presumably they expect significant savings on the other side.
That's the goal. They're projecting that these programs combined will generate about $3.5 billion in total cost savings in 2025.
$3.5 billion in savings this year. That's a huge number compared to the $400, $600 million in costs.
It is. It suggests a lot of the benefit is expected quickly, perhaps from the headcount reductions taking effect. They do note that the full implementation of these initiatives is expected to run through the end of 2027.
So it's a multi-year effort, but they're targeting a big chunk of savings right away in 2025.
Okay, given all this change and the macro uncertainty they mentioned, did they update their outlook for the full year?
No, they decided not to. They're sticking with their previously issued guidance for the full year, which was for consolidated revenue of approximately $89 billion, holding steady on the full year top line despite the Q1 dip and all the restructuring.
Correct. They cited the ongoing macroeconomic uncertainty as the reason for not updating it at this point. They also mentioned that expectations for the second quarter, Q2, will be provided later on.
Understood. Any comments from the CEO, Carol Tomei, that stood out?
Yes, she made comments acknowledging the UPS employees, as you'd expect, and reaffirmed their strategy of using their integrated network and their expertise in global trade. Importantly, she stressed that these restructuring actions are timely and necessary to, quote, strengthen the company in the current environment, basically positioning it as a proactive move to become more agile.
Makes sense. Get leaner and more efficient before potential further slowdowns, perhaps. And how did the market react to all this? The earnings beat, the restructuring news.
The initial reaction seemed quite positive. Reports indicated that UPS's share price saw a noticeable increase right after the earnings yesterday's release.
Okay, so investors seem to like the earnings beat and perhaps the aggressive cost-cutting plan despite the associated charges.
It appears so, at least in the short term. The market often rewards decisive action on costs, especially when coupled with better-than-expected profits.
Well, that covers the key points from the Q1 results and the big restructuring announcement. A lot for UPS to manage moving forward.
Definitely. Balancing cost reduction with maintaining service levels and employee morale during such a large transformation is always a challenge. And navigating that uncertain macro picture adds another layer.
Indeed. It will be fascinating to watch how these initiatives play out over the coming quarters and years, especially regarding those projected savings and the impact on their network.
Absolutely. The scale of the changes, particularly the workforce reduction and facility consolidation, is significant.
All right, I think that brings us to the end of our look at the UPS situation for today.
A complex picture, but hopefully we've shed some light on the key developments.
Thank you for walking us through all those details, and thanks to all of you for tuning in. We hope this analysis was valuable. If it was, please do remember to like and subscribe. It helps others find this information too.
Thanks, everyone.
We'll see you next time.